loan calculator. We're going to wait just a few minutes to get started so we can go live on all the different platforms. We are streaming right now on YouTube, Facebook, Instagram, and LinkedIn. We did put the chat up on the screen, so you can drop a comment there as you tune in. I see people already dropping comments. We'll get started in just a moment. We got a great training tonight, and we'll get started here shortly. Hang tight. All right. Thank you, everybody, tuning in. I see some comments coming in early. Rudy, Adam, Christina, thank you for tuning in early. We'll get started in just a moment. All right. It looks like we are live on all the different platforms, so we can go ahead and get started. We will take the chat off the screen for now, but keep dropping comments there as you tune in. Welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans, and we do these loan officer trainings every Tuesday and Wednesday night at 7 p.m. Eastern Time. Now, we had a great training last night that Jose did, which was based on managing expectations of borrowers, realtors, sellers, and just kind of managing the whole process. Now, tonight, Jose is going to expand on that as well and talk about successfully closing the purchase, right? So you can go ahead and drop questions as he goes on the chat there, and we can answer them when he's done with this presentation. But I'll go ahead and turn it over to Jose Gonzalez, our sales manager with 27 years of experience as a loan officer and a realtor. And Jose, let's talk about successfully closing the purchase.
All right. Good evening, everybody. Thank you for joining us for tonight's training. It's great to be with you tonight. So last night we were talking theory, right, about expectations, right? We're talking, some of it was psychology, some of it had to do a little bit with sales. And, it was a pretty good introduction to help us get into the nuts and bolts of the matter, like we're going to do tonight. Tonight we're going to be concentrating on a purchase transaction, right? So, there are certain expectations that all of the participants in a purchase transaction are going to have, right? You have the buyer, who will be your borrower. You have the seller, or in more complicated situations, sellers, where you could have one, two, three, four sellers, where one may like the deal, the other one may not like the deal, and then they're going to be giving you static pushback throughout the whole transaction. And then you have the realtors. You could have one realtor representing both sides, or you could have what's in more commonplace, one realtor representing the buyer, who's your borrower, right? It's probably the realtor you're going to be reaching out to the most. And you have another realtor that is representing the sellers. Now, I touched there on the fact that you will be reaching out to your buyer's agent probably the most, and that should occur long before you even have a deal. I mean, when you're pre-approving this borrower, the first thing I like to ask them is, are you, and it's for a purchase, I like to ask them if they're working with an agent, right? I like to find out what's going on in their local market. I like to get a little market research. And usually that agent who's helping out the borrower is the one that would be able to give me the most insightful information. If they do not have a realtor, then I would strongly recommend that you find one for them. You could do your research to find the best candidate. If it's an international borrower, for example, you could reach out to the CIPS, which is a Certified International Property Specialist, NAR designation. If it's Residential borrower, you could reach out to the CRS, Certified Residential Specialist, right? That's another NAR designation. If it's a commercial transaction, you could reach out to a CCIM, which is a Certified Commercial Specialist, right? So there are specialists for each scenario, which would be very advantageous for your borrower to use and for you to have a nice open two-way line of communication so that you could get all the insight necessary and so that you could provide them the insight necessary also when it comes time to draw up the purchase agreement with something that is viable for the transaction that we're talking about, right? Whichever it may be. So let me share with you what I have here, right? So we're going to be talking about successfully closing the purchase. Let's wait for the image to come up there a second. I think last night we had a little bit of a delay, the same. Oh, all right, here we go. So, successfully closing the purchase, right? So, a little rehash on some of the stuff from last night, but you see there the weight of the expectations on the transaction, right? The expectations are always exceeding the reality. That's what's going to happen, and that's our job here. Well, we're going to get into all of this tonight, right? Because we're talking about educating buyer, realtors, and sellers, right, with the knowledge they require to make an educated decision so that you can meet their expectations. That's why I'm talking about this two-way communication for depending on the transaction type and depending on the needs of the borrower, your specific borrower. If you do it successfully, you can see there from all my bullet points, it's going to be a very positive situation, right? Especially if you're working with investors, they're a lot more demanding on the transactions. They're going to be a lot more appreciative, but they're going to be a lot more demanding. The savvier they are, the more demanding that they will be. But in the end, if you successfully convey everything and everything is smooth, the end result will be more referrals. Everything will happen a lot easier. Everyone knows what to expect. So we went over that last night. I just wanted to refresh the memory of those that were with us last night or give a little insight on where we're coming from for those that weren't able to join us last night and are jumping into part two, right? You want to make sure you add value. All this will add value to your service as well. That's the whole key. Remember, in this new era of lending that we're in, you will not survive unless you add value to the transaction in everything that we do, whether it's real estate as a real estate agent, whether it's lending as a loan originator. You have to add value. You just can't be an application taker and you just can't be a contract writer, right? You got to be a consultant. People will seek you out if you're a consultant and they will not shop you. They will not nickel and dime you. They will not ask you to chop your commission because you're adding value and they're afraid to lose your service, right? Remember, that's how it should be. You're a valuable member of their team, whether they're an investor, it's their investment team, whether it's their purchase, it's the happy home purchase. You're a valuable member to make that dream a reality. They don't want to lose your service. They don't want to lose the opportunity of working with you. And that's the way it should be. And that's not going to happen unless you're adding value. So let's get into some situations here, right? So, first example putting forth here is your standard conventional purchase. Now, you know that all conventional loans are full doc, right? It's either going to be full doc, salaried borrower, where maybe you're only going to have to provide W 2s and pay stubs. Maybe they have an investment property or they're self-employed, and you're going to have to provide tax returns, right? So if you need to get tax returns, you have tax transcripts to consider. If it's January, February, March, or April, the middle, or let's say March and April, right there, the rush of the tax season, IRS is swamped. Those tax transcripts could take 2 or 3 weeks turnaround time to obtain, right? So and on top of that, if they just filed the tax return, that could delay it a little longer. Then we have to look for the different workarounds that we have. But nevertheless, it's a consideration and one of the things that you need to communicate in the transaction, because the expectation in your typical conventional loan is closing in 30 days or less. I mean, I'm having people asking me, can we close in 21 days? Because there's that much competition for the properties. So they feel if you can close quicker, I guess that's better, right? So again, the reality is on your conventional deal, they are a little bit easier to close, especially if you don't need tax returns. So the reality could be 21 to 45 days, right? Because some of the items that could result in longer turnaround times to get your clear to close. For example, like we were discussing yesterday on the appraisals, if you have remote areas, right? We had one in one of the islands, I think in North Carolina or something like that, where it was like over a month for the appraisal, and it was like super expensive. It was like one appraiser that handled that whole area, and he did it when he got around to it, and he charged whatever he wanted to charge. You take it or leave it. So if you know about that, that's where the communication that I was mentioning in the first slide comes in. Underwriting turnaround time will also vary between investors. If you're a lender like us, and you depend on the investor to underwrite the loan, different investors that you choose are going to have different turnaround times. So when you are sizing up the deal and it's a purchase, you have to be more aware and convey clearly to your borrower that it's not just about the rate that we're concerned about here. It is about the turnaround time on the underwriting, and that one option that may have maybe a 0.25 of a point lower cost in the rate may have a 5 or 6 day underwriting turnaround time versus the other one that could be same day or next day turnaround time. And usually the extended turnaround is going to apply to conditions review as well. So keep that in mind. And if you have to do a credit rescore because the borrower just absolutely wants the best rate and they just paid off those accounts, well, that's going to add to your turnaround time as well. And if there's some seasoning issues with the property, which may require a second appraisal and other hoops of fire to jump through, those are other considerations. So it's not always as simple as it seems for your conventional loan, but it all comes down to the loan officer doing a real thorough assessment of the situation and then being able to communicate that clearly to all of the parties involved, especially when nowadays they want to close yesterday. So I know everybody wants to hear yes, 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 but again, convey it. Usually we may get in on the deal when the borrower already has the contract. We pre-approve them, but still, even if you haven't had a chance to reach out to anybody until that point, once you do get into the deal and I see what I'm facing, I always like to tell everyone involved, hey, we may need an extension here. If I'm looking at a 21-day or 25-day closing period, buyers don't always come to us right when they execute the contract. So keep that in mind. So that's our conventional purchase, right? Usually expectation 30 days or less, 21 to 45 days is the reality. So now in our standard FHA purchase, again, closing in 30 days or less, the reality again would be pretty similar to the conventional 21 to 45 days. Some of the different now, all FHA loans are also full doc, right? It's going to be and they're always going to ask for 2 years of documentation on the FHA, and you're going to need the tax returns. So again, we just mentioned tax transcripts and how that could affect your turnaround time on the clear to close. FHA loans, you need a case number before the appraisal can be ordered. So that may add another day or two, depending on the lender or investor where you're submitting the loan. Again, similar situations here with remote areas on appraisal and different turnaround times on appraisers. I mean, on underwriting, credit rescores, QC. QC is an additional 24 to 48 hours. So after underwriting usually clears the file then goes to the QC department before you get the clear to close. That's the same for conventional loans as well. And with FHAs, also property seasoning can be an issue because FHA has a 90-day rule to even be on a flip to even be able to enter into a contract. And then when you do have one of those deals that they are after day 90, they're still going to require a second appraisal. I can't remember if it's less than 3 to less than 6 months, but basically there is a requirement there for a second appraisal when the value is appreciation is also exceeding a certain dollar amount. So you'd have to study your FHA guidelines. If you're dealing with a flip property, see when they bought it, see what they bought it for, see how much the property is appreciating based on the sales price, and then act accordingly by letting everyone in the transaction know what's going to happen. So FHA deals, 21 to 45 days would be the reality. Now we're throwing a couple little twists here. We talked about our national DPA program when we had our DPA, that's down payment assistance training the other day. Um, our national program is a more streamlined program. It is not handled by a governmental agency. And typically it is going to add some time, but again, the expectation on these deals is they expect you to close in 30 days or less. The reality is it's probably going to be more like 45 to 60 days. Again, similar issues to consider as the other FHA loans. However, in this scenario, you're going to have a second mortgage, which is going to add to the turnaround time of the clear to close. So, again, these are all points to consider, and hopefully, you convey this to the borrowers slash buyers, real estate agent before they get into the deal so that they can try to negotiate these terms. However, it may be a little difficult, as we know, with this tight inventory. So there's other considerations there, but at least you put it forth so that they know, and then how they handle their business to try to get the contract is their prerogative. But nobody is going to be able to point the finger to you if you laid all the cards on the table up front. So this is with our national DPA, right? Now, when we're talking about the local DPAs, these are the ones where it's handled by a municipality, by a city, county, state organization. You're talking about dealing with governmental organizations. You're talking about the first mortgage having to be approved before they can submit to the second mortgage. So again, the expectation out there is always 30 days. And now they want 21-day closings, right? But the reality is this is going to be more like 60 to 90 days, right? And the reason mainly is going to be because of the second mortgage. The first needs to be approved before the second can be underwritten. So that's definitely going to add to the turnaround time for you to be able to obtain your clear to close. The other considerations are all pretty much the same as the other FHA loan, the case number you need. And then if it's a remote area, those are just basic uh, for all loan types. Now we're talking investment property full doc purchase. Now, here by full doc, I'm talking about traditional full doc, which could be with tax returns or pay stubs. We're talking bank statement investment purchase, which is another full doc. We're talking about profit and loss, which is another type of full doc, right? So obviously, bank statement and P&L will never require tax returns, but the traditional full doc may require tax returns. So, again, bullet point number one has to do with tax transcripts. Now, this I would consider it more in line with your conventional loan in terms of ease, and maybe even a little bit quicker. Now, because here we're more talking. I guess I should have put investment non-QM, right? Because in the conventional, I would lump in the conventional investment loan in there. So I should have labeled this non-QM investment full doc purchase. Excuse me, because we are talking about bank statement loans and P&L. So those options, obviously, the non-QM loans, a little bit less hoops of fire to jump through. So those are going to be the ones that you're going to be able to close a little bit quicker. So those would be the ones that would be closer to the 21 days, especially if you don't have to worry about any kind of a tax transcript or anything like that. So again, expectation closing in 30 days or less. Reality could be 21 to 45 days. Now, our investment DSCR purchase, those can close a little bit quicker on top of that because you're eliminating the component of the income, personal income of the borrower, right? Tax returns will never be needed. So besides having a potential seasoning issue on title for the appraisal or any of the other types of issues that are similar to all the other deals, this loan is basically appraisal, title, credit report. You already have, bank statements. So, it's very quick. I mean, you could close this loan, if you got the appraisal in quick and you get the title work quick. I mean, however long it would take you to meet the disclosure requirements for your 3-day CD, which we abide by, and those other kind of disclosure requirements, that's pretty much it. You could close this in 15 days, I think would be the soonest you would be able to close it, but reality would be 18 to 30 days on the DSCR loan. Because they're just less moving pieces on that loan. And typically, not always, I'm not trying to generalize here, but usually on the DSCR loans, we're going to be dealing with an experienced investor that usually will have done this before and is going to have their documentation more in order to be able to proceed smoothly. However, if you do have any credit issues or any of these other issues here brought up on these bullet points, those are all things that would need to be communicated definitely to the buyer's agent so that he could try to negotiate as favorable of a closing date as possible so you can meet those expectations. And then we're talking about now the one that would take the longest to close, which would be a commercial purchase. Commercial, I'm talking about, multifamily, or it could be a warehouse or, something like that, where some of these multifamily loans, depending on which conduit is being used, could take 180 days to close, depending on how many moving pieces there are, right? The due diligence period alone on some of these deals could be 90 days or longer. That's like what we would consider in the residential side, the inspection period, but they're calling it a due diligence because the buyer of the property is going to want to ensure that they can do with that property what they want to do, because they may not always be contemplating the same usage as the current owner, right? Maybe they're going to do a variance, they're going to change some of the uses, they're going to change some of the population density there. That does happen in these deals, and that's the reason why they can ask and will want a longer due diligence period while they go through those motions to see if they can get whatever they need changed, right? It's not as simple as, yeah, I'm buying that house and I'm going to keep it as a house. It's like, hey, I'm buying this space and I'm going to turn it into that usage from this usage. And it usually requires you to go in front of a zoning board and get variances approved or different things approved to the architecture, that if you can't get that done, you're not going to want to close on the purchase because it's not going to suit your needs. So again, real important to take that into consideration. And another point is on commercial loans, on commercial purchases, depending on the size of the transaction, it may involve multiple lenders on one loan. They could have the person that covers the first part, the entity that covers the second part, because maybe they reached their limit of 7.5 million and it's a $50 million transaction. So lender A covers the first part, lender B covers the second part. So that in itself will also add to the turnaround time. And then the other bullet points are all very similar. Typical things that you should consider on all of your loans, right? All of these things, if you need tax transcripts, if it's a remote area, the investor that you're using, if you're going to rescore, if it's a seasoning issue on the property. So those are all things that you have to take into consideration on your every deal, and also on the commercial. But notice this could take anywhere from 90 to 180 days to close. So then, recapping everything that we've gone over tonight, I decided to throw in one of the slides from yesterday back in here because it sort of ties this all in together. Because we've been speaking in sort of generalities here because we don't have exact deals, but you can see how we connect the dots here, because it's all about communicating with all of the participants in the transaction, right? If you properly meet their expectations, that can make the difference if you're going to, for example, get the extension that you need because of the hurdle that you thought may have did come up, but now you had already told them, hey, this may come up, and it did come up. Now you're going to tell them, hey, guess what, man, I need a little more time because I got to resolve this issue. Oh yeah, you did mention that. So now they go to the seller and they can get the extension for you, right? So that's very critical in these transactions, which boils down also to accurately representing your borrower, you doing your due diligence. I mean, everything that you should do on every deal to make sure that you set the expectations straight from the beginning. No last minute surprises. You come up with a last minute surprise the day before you're supposed to really, they think they're closing tomorrow, and you just hit them today with, I need an extension for 2 weeks because of ABC, and they're going to say, man, but did you just find this out now? You mean you didn't know this last week? Chances are you did. You just were afraid to communicate it because you thought they were going to get upset one way or another, and they're really going to get upset now because you didn't tell them a week ago. So it's just the opposite. Those last minute surprises are not good. If you inform them of the potential hurdles up front, if those hurdles do become reality, you're going to be able to deal with the situation a lot easier, and you're going to get your extensions if needed, and you're going to close. So again, communicate to all the participants in the transaction, and you'll be more than 50% of the way to your closing.
All right. I don't see any questions here for you, but definitely a great training. Guess the key to tonight is the key to last night, which is communication, right? I mentioned last night that they did some studies. The number one complaint about loan officers from both realtors and clients is lack of communication, right? So for those of you at the mortgage calculator, that's why we have all these cool things built into the CRM to communicate with the borrower and the realtor, and all these opportunities for you to make sure that you're keeping everybody in the loop. So thank you everybody for tuning in. Thank you, Nick. Thank you, Jose. We do this training every Tuesday and Wednesday night at 7 p.m. Eastern. So we hope to see everybody next Tuesday at 7 p.m. Eastern for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Everybody have a great night.
Thanks, everybody.
Thank you, everybody. Good night.